Hello viewers and welcome to the channel. In this week's video I'll be discussing the Australian property market and my views. So what is going on in residential property right now? Very different question to what's going on in commercial property. So what I've got on the right is an article I found on realestate.com.au, which is a very typical example of the sort of coverage we're seeing driving the hysteria in residential prices at the moment. And that's spot on. Record low rates and FOMO are key drivers of this huge buyer surge we're seeing right now. Getting down into the weeds, there might be a few other trends driving things. A lot of larger homeowners downsizing and raising cash to buy their kids or provide their kids a deposit to get into the market, things like that. But certainly the low mortgage rates are a huge driver of what we're seeing. And that hasn't necessarily followed on to the commercial market, but for good reasons, and I'll get into that in a moment. And this is just a chart of the performance of some of the major property groups on the ASX over the last 5 years or so. SCG here is Scentre Group. Actually, that was previously part of Westfield, so I don't know actually that's been around for that long yet, but perhaps it has. But that's the owner of the biggest and best shopping centres in Australia, which I think is somewhat instructive, and I'll get into that. Vicinity again also owns a lot of good shopping centres, but a little more diversified. Stockland also has a development arm and a lot more residential, and once we start to get to GPT, probably I'd say they have a larger exposure to the office market. But yeah, very little residential in here exposure, which is why what you're seeing here is a significant downturn once the pandemic's hit. On the view that, at least in commercial, the rents that these groups have been accustomed to and obviously currently make up their portfolio right now are going to start to lower in future lease renewals, either based on turnover-based rents, which obviously a lot of retail groups out there are pushing for, and that's even despite the low interest rate environment, which has been very positive for them. And this, I think, is a very important thing to note here. So this is the Australian 10-year government bond yield, and this is a very different thing to consider for one, a residential investor or buyer, and a commercial investor. So what we've seen is for the last 5 years or so, that 10-year government bond yield, despite no crisis here really, just hasn't really gotten above that 3% level. Inflation just really hasn't taken a hold, despite a very decent operating environment, and despite a very strong employment environment. And we just haven't really seen the wage growth that you would need to see a sustained rise in inflation that would drive a rise in this 10-year government bond yield. But of course, as the pandemic hit here in this period, those bond yields fell even further, and only, of course, recently now, as governments spend to stimulate economies, we're starting to see these 10-year government bond yields blow out. Now, this is a very similar chart in the US government bond yield picture as well, and shows the likelihood now that as economies are recovering, that we are going to see eventually interest rates rise, or at least certainly bottom sooner than what was feared here in this period. And this is likely going to have an impact in the property sector, but to different degrees, depending on what we're looking at. The problem, of course, for residential buyers right now is they have no concerns whatsoever about this, and they're being able to get mortgage rates of in the 2% variable rate range, which is, of course, a very low historical rate. In fact, all-time historical lows, and not surprisingly, that's driving demand for residential. But as we start to enter this period, if we do start to see, as these 10-year yields are predicting, interest rates rise, there is absolutely risk that we're going to see a residential pullback from these elevated levels. And say, as an investor in residential, I'd say that's a big risk. If you're obviously an owner-occupied, it's a different sort of risk you're taking on. And where to from here? Well, I've overlaid the inflation rate here, which, as I've said here, starting to rebound, and there's expectation obviously that's going to start to bounce back a lot. Of course, we're still well short of that 2 to 3% target range for the RBA. The RBA has said that they're not looking to increase rates for at least 3 years. Again, this is a big driver of residential prices at the moment. But I think that's obviously a big risk from here, is where that inflation rate goes. In summary, I just say that as an investor, very different view on where the risks and potential lies. I think if you're buying in the residential space, it's going to be very hard to make money outside of this possibly bubble that we're in right now. Yeah, this may continue on. We've obviously got low rates to come for a while. An economy that's recovering. People may continue to have FOMO and drive that market higher, but there is reason to think there's risk to that outlook. On the flip side, I think commercial in the right spot has potentially quite exciting returns ahead of it. Certainly names like Scentre Group, which I mentioned in that chart, as an owner of some of the best shopping centres in Australia, I think they are looking at, as long as foot traffic holds up, which certainly we are starting to see that their foot traffic levels are almost back to pre-pandemic levels. It's a very hard sell for a retailer to say they deserve to pay lower rent when they're seeing the same foot traffic that they were than pre-pandemic. So names like Scentre, I think, offer potential upside. Although I should say that as bond proxies to some degree, these property groups could be, obviously, while the operating environment might improve for them, they could see some weakness because of that bond yield. Because that bond proxy nature they tend to trade as. Even further into it, I think suburban commercial property offers upside. A lot of people, anecdotally, I'm hearing, looking for office space outside of the CBDs, and that's, I think, going to continue to drive demand for space, commercial space, in suburban areas. And if you believe that's a trend that's going to continue, you have to say that office CBD space still looks vulnerable despite the improving pandemic picture as vaccines are administered, and as obviously people go back into offices. There's no doubt that to some degree that work from home theme will continue to hold at least some role in people's lives, and that could be a big risk to office rents, but at least to some degree that's been reflected in the share prices of the major office property investors out there. So look, really, to some degree, I'm bullish on commercial property, but it's going to be the right commercial property, and very nervous about residential property as an investor. Anyway, thank you for listening. If you found this video useful, please click like and subscribe. I'll be back to you next week with a new video.